Hello, hello. Yeah, mine's on.
Oh, I guess it's working. Okay. Hmm. Shall we start? Yeah? Yeah. Fine.
Sounds great.
Yes. Yeah. So it's 5:20. Yeah. Probably we will start. الصوت كويس ولا عالي؟ أنا حاسه عالي. Okay. هي كده أحسن. طيب. السلام عليكم ورحمة الله. This is Badr Adibani. I'm the CFO of Startups House Investment Company. We are an incubator and accelerator, and a private incubator and accelerator here in Jeddah. Our head office is in Cake, King Abdullah Economic City. I'm also running our sister company in consulting. I'm also a financial consultant. Uh, Probably we share a lot in common in terms of consulting, similar backgrounds in accounting. I read your profile, by the way. Yes. So today we're going to have this wonderful presentation with Mr. Clark. I will give the floor to Mr. Clark to introduce himself and probably tell us more about the subject.
All right. Can everyone hear me? Okay. Um, yeah, Badr, thank you so much for having me.
No
And
problem.
yeah, my name's Clark Holscher, and I'd like to say that I'm very excited to be here. A little bit of background on me. So, originally from the States, I'm an American CPA. My father was also a CPA. So we have a saying in the States: the apple does not fall far from the tree, and that is the case with me. Um, and about 10 years of accounting experience. So worked in public accounting in the States. I did some bank auditing, construction work, construction consulting, did some tax work, did some work with high net worth individuals as well. Got a great exposure. And almost 6 years ago now, I moved to the country of Oman, and worked there as a training manager or as a finance manager of a training center. And so that was my first exposure to the Middle East, and loved it. And in course of working with that training center, my the managing director of that training center was actually American, and 3 years into my time there, I actually helped him sell the company to another Omani company. So I have a little bit of experience in valuation as well. And about 2.5 years ago, started doing my own training and consulting, specifically in accounting. And so I do a little bit of kind of contract CFO work, but then also do training. And actually, I love the training. And you could call me a nerdy accountant. I love accounting. I love teaching accounting. And part of that is because I believe it's a powerful tool, especially for startups and entrepreneurs. And I love being able to give as many tools to startups as I can. And so happy to be here. And just also over 2 years ago, started teaching an accounting course for an MBA program based in the States. And actually what I'm going to be teaching today and the methodology we're using is actually pulled from the MBA program that I teach at in the States. And so, yeah, I'm excited that all of you are here, and we might have some additional people joining us, and hope that's the case. And so a little bit of structure of today, of the presentation. I think we will have a break about an hour in for prayers, and we'll do mostly presentation for the first half. Second half, we'll have a little bit more presentation and also an activity. So most of the time that I do this training, it's either 1 or 2 full days of training, and we cover a lot of topics, even in 2 days. But I wanted to give just a sample of that larger training to you and try to give you as many of the golden nuggets of the training today so that you could actually practically use it even tomorrow. So that's a little bit of the structure of the time with you today. Now, when most people think of accounting, they probably think it's boring, but oftentimes they think, okay, accounting is... Am I going off and on? Is that okay?
Yeah, it's on.
It's on. Most people think of accounting, they think, okay, calculations, calculators, maybe it's receipts. If you're a startup, you have to give all your receipts to the accountant so he can run the numbers, so he can give you the financial statements, so you can submit it to the auditors, to the bank. And maybe many of you think of it in terms of just, hey, this is regulatory. Accounting is something that I just have to have done for the tax authorities, for the bank. But I'd really like to change your perspective on accounting today. And specifically, I'd like to change that dynamic away from receipts and a confusing topic to specifically accounting is a piece of the dashboard that you as a startup or you as a manager in a business, you as the person flying your business, you need as many pieces of data that are going to help you run and going to help you fly that plane of your business or the plane of your personal finances or the plane of a startup house like this one. You need as many aspects of, well, this is not going to show up on the computer. You need as many aspects of data, of metrics that you can in order to make good business assessments, in order to make good business decisions. And that's what accounting is designed for. In fact, the first accounting textbook was actually written 500 years ago, and it's largely unchanged. And that was designed, and the accounting system was designed in order to represent, in order to demonstrate stewardship, where's the funding going and what is in my control, and performance. And it's largely unchanged even today. Another way you can think about accounting is telling the business story. So accounting, or a finance professor of mine in university used to work for Bank of America. And he worked on Wall Street for a number of years, and his job at Bank of America was to identify smaller companies that Bank of America could take an equity position in or a debt position in order to grow that company so they could profit together. So my finance professor would often identify several different companies and bring them to his boss, one of the top partners at Bank of America in New York. And my finance professor recounts numerous times in which he would identify a very possibly lucrative business that looked very profitable, that looked like a great company to invest in. And he would submit it to his boss. And oftentimes it would literally only be 6 pages, maybe 3 years of balance sheet and 3 years of income statements. He would then put them on his boss's desk, and he would say, okay, boss, I really think this is a good investment. What do you think? His boss would literally take about 5 minutes, review one year, maybe flip back to the other year, do some quick comparisons. And now, for disclosure, he probably could do math really fast in his head. And he could probably do some analysis that most of us require a spreadsheet to do. But at the same time, he was only looking at probably 6 pieces of paper. He'd then slide them back across the desk to my accounting professor. He used to work there. And he would say, John, this company is having issues with their supplier, and until you find out what they're doing about it, and if it's a reasonable solution, I'm not going to invest $1 in this business. You're thinking, wow, that's pretty remarkable financial analysis. How in the world did he take data from 6 pieces of paper and having no conversations with the management team at this other company, and he knew instantly what was going on in that business? The reason for that is should I get on this side? The reason is he understood that financial statements tell stories. and he knew how to pull the data from the financial statements in order to understand the story of that business. And that's what we hope actually to do today, in helping you understand the business story that's articulated through the basic financial statements, the balance sheet, and the income statement. Now, with most accounting and most finance for non-finance curriculum, trainings, most of them start kind of where this start place is on this plateau. And they say, hey, we're going to start here, and we're going to continue through this course. The problem is most people start 3 miles behind the starting place. And part of that is because the terminology in accounting is often very confusing, and not enough time is actually spent on what do these terms mean. One of the things that I like to say in the training is actually some of the most confusing things about accounting and finance are not the numbers. It's actually the words. It's actually the terminology we use, and there's so much confusion around those words that you can't make sense of the numbers. So we actually make it a point to actually reel it back a little bit, and we start at the very foundation. One of the other things I like to say when doing this training is accounting in and of itself is not intuitive. It doesn't make sense automatically to you. It's not common sense. It's actually a system of organizing financial events that you have to learn. And many times it's not intuitive and very confusing if you're just looking at it. Especially, I don't know how many of you, if I could just have a raise of hands, who here is an entrepreneur or is working in a startup, just out of curiosity? Okay, a couple. How many of you have tried to input data into your accounting systems? Whether it's Xero, QuickBooks, Tally, okay, a couple other hands. There's a lot of confusion that happens because when people design accounting systems, there's a lot of things that are going on in the background, but if you don't have that foundation, you get lost, and it becomes really confusing. Yeah. Yeah. Oh, okay. Okay. Fantastic.
Okay.
So a little bit more. Okay. This might be a little challenging for me because I often move, oftentimes in the training. In fact, one of the challenging things about it being live for me is actually most of the time it's a very interactive training. I love having lots of interactions with my students. And so because there's so many of us, probably one of the things that I will do, that I'll try to do, is when I ask a question, I'll say, okay, think of an answer in your head. And then I'll keep going with the questions. And part of that is I do want to solicit feedback and questions, but in the interest of time and with so many people, we might continue going ahead. But yeah, accounting is not intuitive. And so most of the time, accounting knowledge, even in a university setting, starts assuming that you can do basic financial analysis without actually building the foundation of, we say, not even financial literacy, but accounting literacy. And we actually think that's a precursor to finance because so much terminology of accounting is used in finance. And so we say, let's build that foundation strong from the beginning. Now, in this session today, we're going to spend about 1.5 hours to 2 hours together, depending on how long the activity goes. That's a very condensed training. Now, most semesters in university, they're about 5 months. Oftentimes, the accounting training that I do is in 2 days, and we try to compact a lot of accounting knowledge in that 2 days. So suffice it to say, we're going to be sprinting a little bit today, and it might feel like you're drinking from a fire hydrant, that we're going at a really fast pace. And that's okay. But I think I do want to give you as many tools and expose you to as many things about the basics of accounting to help you in your businesses, to help you with your NGOs or startups, to help you even in your personal finance. We're going to see that today. So, any initial questions, brother? Any things that stick out from...
Actually, I just want to give them a tip. basically, whenever you feel like it, just pause him, ask questions, whatever. Yeah.
Yeah, and great. And just a hand. And if it's a question that I think we'll address later, I might say, great question. We'll hold it for later. But I'd love to have any questions. Okay? I'm seeing some nodding heads. I think you guys are going to be very excited about accounting in about 30 minutes. You guys aren't there yet. You're slowly getting there. Okay. Now, one of the things I do in the broader 1 to 2 day training is actually starting with a baseline. And we actually pull financial statements that actually came from a real business, a balance sheet and an income statement. And I get the students to evaluate those and read them and say, what do you understand? What makes sense? And it's a little fuzzy, but there's a lot of different terms on the balance sheet and income statement. And for those of you who have either taken accounting before or have worked in the finance sector, many of you have seen many financial statements, many balance sheets, many income statements, even supplemental statements such as cash flow, stockholders' equity, other things. And what's interesting is, for those of you who have moderate accounting experience, you actually see that although, yes, balance sheet and income statement is required oftentimes for most businesses, there's actually a lot of variety. And there's a lot of different words that are used, even if we're comparing Airbus to Boeing. Same industry, very similar companies, and yet if you pull up their most recent financial statements, you'll actually see a lot of difference, even in how they present the data. But, and that varies across industries, it even varies across just different companies. That said, all accounting can be summarized in 5 categories. Regardless of what industry you're in, regardless of whether you are a for-profit company or an NGO, there are only 5 major categories in accounting. And in fact, that's what you've come to learn today, are these basic 5 categories in accounting. And that's what we're going to be going through on a deeper level today. So even though all companies have some sense of variety, and just a disclosure, a little bit of a confession, I guess, as an accountant. We often, as accountants, don't like to say there's a lot of variety in a balance sheet and an income statement, but I want you guys to know that especially if you're a startup or an entrepreneur or even in your own business, there's a lot of flexibility that you can have in asking your accountant, hey, I'd like to start tracking this. Can we start? And I think that's a discussion and a dialogue that needs to happen between kind of the accounting department or an accountant, even an outsourced accountant, and especially managers of business. And just a disclosure, like we don't like to say that because we as accountants like to make things easier for us, but accountants often, we serve the business. We serve the management team. And without data, without relevant data, it's really we don't supply the necessary information to the businesses. That said, even with all that variety, there's still only 5 major categories in accounting. Now, we're going to jump into a situation and jump into a scenario, and we're going to use a supermarket business as an example. Do you have any? Yeah. Yes. Yeah. Sure. So color accounting is a way to explain accounting. It's a training specifically on how to pull information to understand the basic balance sheet and income statement and to use it for your business. It's not an accounting system. We explain all of accounting. So we actually train entrepreneurs. We actually are in universities. We're in high schools. Goldman Sachs uses color accounting in their training. Absolutely. It's a condensed version. Why in the world drag yourself through 2 semesters of a university of accounting when you can get a crash course in 2 days? So that's what we do. Yeah. So it's a methodology of teaching accounting. A great question. Great question. Okay, so we're going to use this business as an example, and it's a supermarket. But one of the first things that I need to point out is, currently, this is a diagram describing the balance sheet, but we need to define whose balance sheet this is. So one of the things that we do in the broader training is actually describe this idea of perspective and how perspective is so important in accounting. And this specifically, I've seen most confusion when talking to an owner who is also a manager. And oftentimes they confuse the owner's story versus the business story. And those are different stories. And we flesh that out a little bit more in the broader training. But suffice it to say, we're going to define this business as Color Supermarket. And we're going to use this as the example for today's illustrations and for the activity. So every balance sheet, every income statement has at the top only one name. The name of the company, the name of the enterprise, the name of the entity, the name of the government. And it's the same with this. So, Color Supermarket. On the left, in this picture, represent assets. That is the first main category of accounting, assets. So as you look, and I might be blocking the screen for those of you on my left, but if you can take a look at the picture on the screen and ask yourself, or answer for yourself, what assets do you see in this picture? Groceries. Yeah, absolutely. What else do you see? Yeah, oranges, bananas, okay. Would those have a... Oh, okay, we have a philosopher in the back. Yeah, the building. She sees the floor and would have to hypothesize that there's a building that goes to it. Absolutely. Yeah, a building is absolutely an asset. Okay, we have an experienced businessman. It could be a rent and it could be owned. Let's assume they own it. Let's assume we own the building. Is that an asset? Yeah, absolutely a building is an asset. Yeah, groceries are absolutely considered an asset. Now, let's ask the question, is there a subcategory of assets maybe that we call groceries? So we actually have two different types of groceries. We've got maybe perishables, things that have a very low shelf life, and then maybe so we have cereals, some type of like pastas. We got different jars of spices and things. Yeah, absolutely. The cart is absolutely an asset. The shelf is absolutely an asset. So we're actually talking about several different types of assets here. So the shelf. If we're a supermarket, are we in the business of selling shelves? Not really. It's really an asset that's to support maybe the main business or main activity of the business, which is selling groceries, right? Okay, we have nowadays selling shelf space. But let's assume we bought the groceries and we are selling the groceries. And that's very true. Things have changed in the grocery industry these days. But let's assume we bought the groceries. Wouldn't we call that inventory? Or maybe stock? Yeah. We're in the business as a supermarket of buying inventory, hopefully at a low price, and selling that same inventory at a higher price. Right? That's our main business. But the shelf and the cart, that's more of a fixed asset. We hope for it to be around for a while, and it supports the main function of the business, which is selling groceries. Okay, let's think a little bit outside of the box. What are other assets that you think this business would have that maybe not in the picture? Staff, people. Any good HR manager has to say our most valuable assets are our people, right? We hear that a lot. Absolutely, we hear that a lot. And any HR manager, if they are a valuable and very good HR manager, they'll say that. And absolutely, people are very valuable. They're the core of business. That said, do we, in accounting purposes, not asking what is an asset out on the streets, or how do we use the term asset in the general business environment? No. How do we use the term asset specifically in accounting? Because that's actually one of the confusing things about accounting, again, is the terminology. That we use a lot of these terms inside accounting that mean maybe specific things, but we also use them outside of accounting to mean maybe different things. And we're actually going to see that here. So the question is, are people assets? Are people assets? To answer that question, we need to say that an asset, we recognize an asset, or we put an asset, or we list an asset on the balance sheet when it meets two criteria. Two criteria. Can anyone guess at what those two pieces of criteria are that have to be met in order for us to call something an asset? Close. Yeah. Long term. There's an element of long term. Of course, you could have short-term assets, right? I mean, inventory. Right. But this is the definition for all assets. What is the criteria for all assets? Wow. Absolutely. Ownership. Is something controlled and owned by the business? Do we have an accounting professor with us? Is that trying hard? Absolutely. It controlled or owned. Can you own people? Not really. No. Sometimes I have a smart person say, well, what about football players? Real Madrid, Barcelona, they own their players, right? Of course, I would argue they're happy to leave or to retire. And really, I would argue that they're really owning the non-competes to them and their contracts. Yeah, and so it's really not the people. It's really kind of rights to their sports usage is really. So we don't own people. In fact, what do we call it when we own people? Slavery. Absolutely. And slavery is outlawed, right, across the world. Can an employee can one of your employees choose to go work for another business? They absolutely have the freedom to do that. However, can your vehicle, can your car that your business owns, can it drive itself down to the municipality, go in and change its ownership to another business? No, absolutely not. You absolutely can own a car. Absolutely. Now, so we got one. It needs to be controlled or owned. Something that is controlled or owned by the business. What's the second criteria? Any guesses? Close. Batting 1,000. That is very impressive. 100%. Yes, it needs to be measurable. You need to be able to put a value on it. Can you value a human being? Not really. Not really. I think God would say we're all way too valuable to value. Absolutely. In theory, yes. In theory, yeah. Yeah, in slavery. Absolutely. But, I mean, and many of us have people very, very close to us. Many of us have even lost people close to us. Can you put a value on that? Like, how much would you pay to have them back? I mean, you would say, I'd give anything for them to be back. How do you put a value on people? Sometimes I do have people who have worked in the insurance industry. I did do a little bit of work in the industry of insurance and say, well, we value people all the time. But really, that's not the comprehensive whole value of a person. That's really their earning power to support their family is oftentimes how people are valued. Okay, yeah, so an asset, in order to define something as an asset, it needs to be controlled or owned and measurable. And specifically, measurable, quantifiable, using a currency. Because that's typically what we use in accounting, some type of currency. Now, the question is, do people meet either of these criteria? No, absolutely not. On both counts, we can't include people as assets. But we've learned something now. We've learned something about assets, that specifically an asset needs to be able to be controllable or controlled or owned, and it needs to be measured. Now, going back to the picture of the grocery store, one of the things that we discussed, and I'm actually a little surprised, I think I have a handful of entrepreneurs in the room, there was one asset that wasn't listed, that I'm a little surprised that no one jumped in. You said people, which I guess we jumped onto that first. Can anyone think about maybe the most important asset for specifically a startup? Could be brand name. That's very valuable. Reputation arguably is very valuable. Mm-hmm. Intellectual property. Wow, we have some really sharp people here. Intellectual property is extremely valuable. It's an easy one. Cha-ching. Cash. Is cash an asset? Absolutely. It's one of the most important assets for a business, and one that needs to be measured, one that needs to be managed, controlled, and planned for very well. But it is absolutely something that's valuable, that you can value, and that it's extremely important. So, but we have almost all the things that we listed are things that are physical, things that you can touch, things that are tangible. However, we also Wissam mentioned one, and the gentleman in the back also mentioned another. Can you have an asset be non-physical, be intangible? Is the term we use in accounting. Yeah, absolutely. There's a lot of valuable things. There's a lot of assets that we can have that are both physical, but also many that are non-physical. Intellectual property is one. Brand name is another. What's another example of something that can be owned by a business but is considered an asset? Goodwill. Absolutely. Goodwill's a great example of something that can be owned by a business. Reputation is something that can be owned. Sometimes it's a little bit harder to measure reputation, so often reputation doesn't get put on the balance sheet unless it's purchased. And then you've really purchased more than a reputation. You've often purchased an entity or a line of activities or something. What about like a patent? System could be. That could be some intellectual property. But what about like a patent? You own the patent to a very remarkable technology. If you had the patent to the iPhone 12, do you think that would be considered an asset? Yeah, I think so. I think Samsung would love to get their hands on that, right? Yeah. Or a copyright. You know, if you are a book publisher, one of the biggest assets that you have is actually the rights to so many books that you can then publish, whether digitally or physically. Do they physically have the books? Yes, but more they own the right to print it, which is really intangible. So we've described that assets can be tangible, physical, but they can also be non-physical. And just a hint, of the 5 categories, assets is the only one that is physical. No other category in accounting is physical. All the other 4 are non-physical things. Just put that in the back of your mind. Now, in color accounting, we like to condense definitions of these accounting terms as small and as short as we can. And we've actually devised a one-word definition for accounting, for assets. Can anyone guess at what that one-word definition for asset is? Most people can't get it, and that's okay. In fact, I've only had maybe one time in my entire training history that actually someone has guessed it. Valuable. The one-word definition for asset is valuable. It is the only category in accounting that is valuable. Income is not valuable. Let me say that again. Income is not valuable. I'm going to come back to why we think this. But it is the only category, asset is the only category that is valuable. It is the one-word definition. So if you think of anything in accounting that is valuable, going back to the two criteria, okay, it is maybe controllable. Maybe even you could assert in a court of law, hey, this person stole my idea. Maybe you can assert that. But how do you measure it? And can you recognize that cost? Most of the time, you can't. The only way you can recognize that value, how much it is, the measurableness of the asset, is if it's paid for, if it's purchased. Then you have an immediate price in which you can value that asset. But most of the time, it's not. And most of the time, companies are bought that have many mobile applications. And in the finance world, we've often been given projects of kind of allocating how much are these assets worth, but they're based on the purchase price of the whole business. Yeah. Absolutely. Absolutely. Yeah. And Uber's a fantastic example. In my longer training, I'll use Facebook, and now I'm getting to use Uber. And specifically, I like using Kareem's purchase, or Uber's purchase of Kareem, because I think that's really interesting. But I want to tackle it, and it's okay if it's a little confusing. We're going at a pretty fast speed, but in the broader training, we can actually dive into a little bit of these discussions of, okay, how does Uber value these things? And most of the time, though, in accounting, we take a conservative approach, and most of the time that we know if something is measurable is if it's purchased. And if it's not yet purchased, then we would say we probably don't have a mechanism to measure it. That's changing a lot. And one of the things I'll say, too, the accounting world and the legal world are very interconnected. And I think when the lawyers start talking about something having value and describing that, accountants kind of get together and say, okay, do we need to include something as an asset based on its legal definition of ownership and the value? But there's a lot of collaboration that accountants and lawyers have, and specifically because we want to be able to show and tell the accurate story of the business and doing it through the balance sheet and the income statement. But great question. Any other questions about asset for now? And there might be many, and that is totally okay. Yeah. People are not an asset, and they're not an asset doubly. They are not owned, and they cannot be measured. And anything that's physical, need to consider that. Does the business own this? And can I measure this? Otherwise, you can't put it as listed as an asset. And this is one of the hardest things for startups, I would say. And specifically when they have intellectual property that they're building that they know is valuable, but oftentimes we don't recognize it in accounting. We don't put it as an asset until someone buys it. Mm. Yeah. And it's hard. And most of the time, accountants stay away from valuing the reputation unless the whole company is bought, and then you really have a value for that reputation. Yeah. And this is, too, an interesting dynamic. Most of the time, when we talk about finance and valuation, most of the time that's forward-looking. Most of accounting is past tense. We're trying to record what's happened historically. And we're not just looking at the past. We want to use it in projecting what's forward. But, yeah, and yeah, and it's a dynamic. And that's where accountant, like the picture of the cockpit that I had at the very beginning, accounting is just a couple of pieces of your metrics as a startup and as a business. And I think it's really important to know that there's a lot more things that you need to consider outside of accounting and even sometimes outside of finance. And the question of, what are your customers thinking? You can talk about future economic things. What's going on in the competitive environment that I need to address? Those are things outside of traditional accounting. But accounting is still crucial on your dashboard. Okay. Sure. Yeah. 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 Good question. Good question. I might table that for now. Um, but if we have time, I can actually address it, maybe even in our activity, possibly, because one of the other definitions for one of the other 5 categories might address that. So, great question. Okay. In order to start a business, though, you often need to get funding. In a business, what would you say are the 2 main ways that businesses get funding from the beginning? Finance, yeah? Yeah. And how specifically do they finance themselves? Loans? That's one of the 2. Absolutely. Savings. Okay. Interesting savings. Whose savings? So the owner's savings. Okay. So the owner. So a loan, maybe from a bank, but then an investment from the owner. These are the 2 main other sources of funds, we say. And in accounting, we call these liabilities, which is a loan from a bank, or a loan from a family member, or even an interest-free loan from maybe a startup portfolio or something. But they have the intent of giving it back, specifically the amount that they lent you. And that's different, though, than equity, which is the 3rd major category of accounting. Equity describes the owner's investment into the business. And specifically, we like to say that liabilities represent the obligations of lenders on that business. What the business is obligated for to specifically a group of people we call lenders. Sometimes they're called creditors, sometimes they're called debtors. And again, it's the same box in accounting, but we often use very different terms. But this is someone who has given money, but they expect it back. Contrast that with equity. Equity represents the amount that the owners put into the business, and from the business's perspective, the business now has an obligation to the owners. If the business gets a loan from a bank, the business is now obligated to that bank for that loan amount. Or to flip it around, the bank has a claim against the business for the loan amount. An obligation or a claim. Differentiate that between equity. If the owners contribute money into the business, that business now is obligated to the owners for that amount. And again, we differentiate the sources of funds on the yellow side versus the assets. Where did the assets come from? And who are we obligated long term for these assets? Other key differentiators between liabilities and equity. Number 2 and number 3 boxes of accounting. So liabilities are obligations to lenders, and typically, why or for what reward will a bank or will someone loan a business money? What are they expecting to get in return? Yeah, interest. Typically interest, or typically some fixed rate of return for risking their money in your business, right? Now, however, although they are expecting maybe a fixed rate of return, do they have the right to come into your business and demand that you change the CEO, or demand that you change the management team, or demand that you change course in your marketing campaign. No. Unless things are very bad and it's a bankrupt situation, but that's rare. Under the normal course of business, a bank or a lender has no right or no control in the business. However, although they don't have control, they do have something over the owners. And we call this a priority obligation. What does that mean? A priority obligation means in the case that the business sells, or in the case that the business goes bankrupt, the lender is the first to get paid back. Only after that are the owners paid back. Now, in a sale, especially if it's a high-value sale, the owners want the lenders just to have what they put in as the loan. They don't want to give them any more. However, if it's a bankrupt situation, man, that really stinks for the owners, doesn't it? Because they really get the leftover. They get the residual amount. And we actually see that term going to come up later to describe equity. It's a residual obligation. It's a subordinate claim on the assets. And that's a key distinguishing fact between liabilities and equity. Okay, let's describe equity for a little bit. If the lenders or the creditors or the bank lends money to the business in order to get the reward of interest or the reward of a fixed rate of return, why would an owner invest in a business? What reward are they expecting to get? Yeah, profits. Absolutely. Maybe more specifically, dividends, right? A portion of the profits so that the business can continue making money, but so that they can be received for the risk of investing their money into the business. Absolutely. Now, unlike lenders, do the owners have control in the business? Absolutely. They can have a high-level control, meaning they just replace the CEO, the board of directors, or maybe the high-level management team. Or they can come in and demand, hey, I want you to change this small marketing campaign, or I think you need to hire this person over this person. Do they have that right? Absolutely. In fact, it's really their company that they have the ultimate rights to. So that's a key distinguishing fact. But we need these two categories in accounting to describe the differences in specifically who the business is obligated to the lenders versus the owners. Great question. Great question. So I'm actually going to come back to that. Fouad, you're ahead of the game. But interesting, and I'll say this again. There's only 5 categories in accounting, whether that's a nonprofit, an NGO, or a for-profit. So we typically call it something different, but it's the same box. And legally, we refer to it as something different, but it's the same thing in accounting. It's the same thing. Great question. Okay, so let's use an example. So we at Color Supermarket, we're the management team of Color Supermarket, and we decide in order to start our business, we need 50,000, let's say USD. We need 50,000 USD. And we decide that we're going to get 30,000 from the bank as a loan, and the other 20,000 we're going to go get investors to fund the rest. So, on the balance sheet, how do you think we would show that? Well, first, we need to show that we now have 50,000 USD, right? That's cash in our bank account that we can use for our purposes in the business. Buying inventory, renting a building, all these things. And we also need to show, though, that although we have received 50,000, we are now obligated to 2 new parties that we were not before. Specifically, we need to show that we are now obligated to the bank. We have a liability of 30,000. And we also have equity, or we are obligated to the owners for 20,000. Now, one of the things in accounting is things need to balance. I don't know if you've ever heard from that from your accountants, or things often need to tie to the beza, to the penny, to the cent. And that's true. And there's the whole system of accounting has some sense of balance and checks so that you know if you are missing pieces of information. But we can look at it. Is this balance sheet in balance? Yeah. Has 50,000 on the green side and 50,000 total on the yellow side, on the sources of funds. You have now done the basic accounting transactions and having them reflect in the balance sheet. Congratulations. And we see this in the classic balance sheet equation. Assets is equal to liabilities plus equity. Simple arithmetic. Now, another way we can frame this is assets are the objects. They're the valuable things. Whereas the liabilities and the equity describe who the business is obligated to for those assets. Yeah. We're still liable to investors. Well, and going back, so the question was, why aren't we obligated to the investors? We are obligated to the investors, but the investors are owners. And we need to differentiate that between the bank as lenders versus the owners, which is considered equity. Yeah, great question. Now, yeah, and again, just kind of a helpful thing to think about. Objects are what assets are. They're the things that we use in our business to hopefully generate a profit, right? Versus the liabilities and equity, they really describe the obligations of the business or the claims that other parties outside the business have on the business's assets. And this is crucial. Now, I don't want to get too philosophical, but I do want to ask kind of a cheeky question here. What does the equal sign mean? In the equation of assets is equal to liabilities plus equity, what does the equal sign mean? What does it symbolize? Normal math, yeah, okay. This plus this equals this. What does that mean? There's nothing missing? Yeah? Yep. Yeah. There is something missing. Absolutely. Oftentimes in an audience like this, it means same as. It means bad business? Oh, but should they? Should they? They should be higher than what? Than what you owe specifically lenders? Than specifically lenders. Absolutely. But if you have a very high asset amount, but you also show that you have a high equity amount, doesn't that just mean that you've created value for your investors? That's a great thing, isn't it? That's what we want. It's a great question. It's a great question. Yeah, absolutely. I mean, we do want to minimize the liabilities. But the question is, what does the equal sign mean? And most people would say it means same as. And that's where I would say that's not really the precise definition of the equal sign. What it really means is it's equal in value, but it's significantly different in substance. Let me say that again. The equal sign means that it's equaled in value. We value liabilities using a currency. We value assets using a currency. It's the same value. But assets are fundamentally a different thing than liabilities and the equity. And it's just helpful to kind of remember that. There's no cash in liabilities. The liabilities is really a piece of paper symbolizing that the bank or the lenders have a claim on the business. Right? There's no cash. They don't have any cash. Right? They have an IOU. They have a piece of paper saying we owe them money. And that's not the same thing. It's the same value, but it's not the same thing. Okay. One other thing that I almost need to apologize for on behalf of the accounting profession is often how we will have these 5 boxes. We only have 3 boxes right here. But how we will describe and name these 3 boxes actually using different names. but they mean the same thing. I'll give you an example. Another way we can define the basic balance sheet equation, instead of assets is equal to liabilities plus equity, we could do a little algebra. And we could say, well, assets minus liabilities is also equity, right? Simple algebra. However, we don't use the term equity when we frame the balance sheet like that. We call it net assets. And Clark, you're saying, wait a minute, you said assets were valuable. Assets are the things that are physical and maybe intangible. What are you talking about, net assets? And this is where I have to say, I know. Accounting can sometimes be very confusing in the terminology. We add a word, net, onto assets, and it substantially changes the meaning of that term. So net assets is the same thing as equity. And we see this most specifically in governmental accounting and the NGO world. Most of the time, and this is, I'm sorry if Fawad left in this time, but he asked the question of, well, what about NGOs? Do NGOs have equity? No, they don't. We call it net assets, but it's substantially the same thing. It's that residual interest. It's the residual obligation after the liabilities that the stakeholders have in the NGO. But we call it net assets. It's just a slight differentiation. Okay, time-wise, how are we doing, Badr?
Okay.
We might need to break.
It's 6:17, so it's almost an hour now.
Okay. This might be a good stopping place for now.
Yeah.
If we want to take, how long would be best?
10 minutes?
A 10-minute break?
Yeah.
We'll take a 10-minute break and finish up the second half of the presentation and the activity.
Cool. You can come in for any questions.
Yeah. I might. Should I keep this on?
No, no need.
Should I keep the mic on with? I don't know if this is live or not. Okay.
Oh, I guess. ايه عفوا. اوكي. بسيط. طيب. Yes. Mr. Ahmed, can we continue with the discussion later? Maybe. Thank you. Right. So I guess we're gonna continue. Right.
Are we ready? Are we ready to continue the accounting sprint? All right. Now, in front of you is a worksheet, and on that worksheet is something that we call the BASIS framework. So, Color Accounting, we are a training business, and we help educate general public, also university students, in the basics of accounting, and trying to simplifying it, not losing it, not making it overly simple, but making it fantastic and applicable for entrepreneurs, for C-level executives in businesses, as well as for university students, startups, and others. But we use this model. So just like the lean canvas, who here is familiar with the lean canvas? The startup model developed by, not Ryan, but I just went blank on his name, but revolutionized how to approach startups with this one-page module describing the different aspects that a startup needs to have solutions for in order to continue their business, in order to consider all the parameters. Similarly, the founders of Color Accounting built this module that you have on your paper, and we call that the BASIS framework. And that's the heart of Color Accounting, simplifying the balance sheet and the income statement to one module. So we like to say, we simplify accounting, one page, 1 or 2 days of training, and that's equal to almost a semester of accounting. And so it is, it's powerful. Now, the name comes from condensing the balance sheet and the income statement, bilingually, at least. At least in English, we use the term BASIS to describe the acronym of the balance sheet and the income statement, but forming it together. So actually an interesting thing that trips up most accountants, is the income statement connected to the balance sheet? We good? Is the income statement connected to the balance sheet? Hold that question, and we're going to answer it on the BASIS framework here in a little bit. So we use this. And so far in our training, in this one-day class, we've talked about assets, we've talked about liabilities, and we've talked about equity. So we have 2 more to go. But before we do that, I'm going to do a little small refresh, and specifically boiling it down to the accounting transactions that you might see in your accounting systems, whether a big system that's managed by SAP or Oracle, or a more simple system like a QuickBooks or a Xero or a Tally, or even sometimes in Excel that you can do it. So let's redo some of the transactions in the original business. So we had Color Accounting Supermarket up here at the top. And in our business, we decided that we needed 50,000 USD to start this business. And we decided we were going to start this business by getting 30,000 from a loan from a bank and getting the other 20,000 from investors. So we're actually going to do this piece by piece. And I'm actually going to show you in advance of the activity that we have. So we're actually going to break you up into 3 small groups, and we're actually going to do this, we say kinetically, meaning with your hands, with your minds, and actually see this played out on, we call this the real live basis boards. But we're going to do it on the PowerPoint presentation first. So in order to do this, let's go through the first events. So one thing that we like to say in color accounting is every financial event, every accounting event, every transaction has 2 effects. Has 2 effects. So we see this in the first transaction. So we receive 30,000 from a bank. What do we have more of now as a business? We now have more cash, right? But what do we also have more of? We also now have more of a liability to the bank, right? We are obligated to the bank for 30,000. So we need to show both of these things. And in order to do that, what we do is we put 30,000 here on the asset side in cash. We have a little cash bucket that we'll look at later. And then we have 30,000 over here on the liabilities that represents we need to pay this back to the bank or to the lender or to the creditor at some point in the future. And it's extremely important to know that as startups. What are my liabilities and what are my risks? So we did that. Are we in balance? So we increased the green side assets, and we also increased the obligations, the sources of funds on the yellow side. Are we in balance? Is the balance sheet balanced? Absolutely. Let's look at the next transaction, the next event. So we decided...
Clark, shall we get into the discussion of debit credit?
We're going to hold that discussion.
Yeah.
Great question. We're going to hold that discussion for now. Yeah. The interest. Okay, we're just recording the event of the initial loan. So this is as of the first day. As of the first day, in theory, you don't have interest because you just received the money. So we won't be recording that interest yet. But great question. And that's something to consider for the future. Do we need and when do we need to record events? Right? Because 2 months from now, are we going to owe 30,000? Probably not. We might owe a little bit more if we haven't been paying on it because of interest or because of a fixed rate of return. Yeah, great question. Great question, Waleed. Okay.
One more question.
Yeah.
As an entrepreneur, so I'm managing the business. Do I need to know the details of the accounting? I mean, the natural account, I mean, which accounts are debit, which accounts are credit.
We're going to go into debits and credits, but I think what we'll actually see...
For overall, for an entrepreneur, non-accountant, do I need to get into that?
I would say absolutely. Okay. You need to understand it. As an entrepreneur, you need to understand the basics of accounting. Now, can some entrepreneurs, or rather let me phrase it another way, going back to the picture of the cockpit in flying our plane as a business, are there some pilots that do not need the instruments, that do not need the dashboards? There are some pilots out there that can fly their planes without it. I would say they are few and far between, and the bigger the airplane gets, the more important all of that dashboard is. And it's the same thing in a business. The bigger you grow, the more you need to be able and capable of reading certain metrics and certain data and what that means for making good business assessments in order for you to make good business decisions. It's crucial for you to have that information. Crucial. Great question. Great question, brother. And so as we're going into this, we're going to actually look at a couple of different types of sub liabilities actually in our activity together, and to see actually why it's important to know some of the detailed parts of accounting so that you can better plan. One of the biggest issues for startups, and quite frankly most businesses, is cash flow, specifically cash flow planning. And if you don't have a good handle on your liabilities, if you don't have a good handle on how your assets are changing and the different classes of assets and which assets are needing more cash, you're not going to be able to run your business effectively. And you might encounter some really big obstacles, some really big challenges if you don't look ahead. Great question. So let's go back to our business scenario. So we received 30,000 USD from the bank. We also decided as the management team that we were going to go out and get 20,000 USD of investor money, investment. How do we record that event? Well, we'll see that we need to show that we now have more cash, right? Because we now have 50,000 in cash. So we need to show that we've had an increase in cash. But unlike the transaction with the bank and that going to liabilities, we now need to show that we now have a different group of people that we're obligated to, and that's to the owners. We need to show that in equity. So we do. So we put 20,000 in cash, in assets, and we put 30,000 in equity. Again, looking at the balance sheet, are we in balance? Yeah, we increased cash. We also increased the source of funds specifically on equity. Are we in balance? Absolutely. Absolutely. But now, we've looked at two sources of funds. There's a third source of funds in business. And arguably, it's one of the more important sources of funds. What is that third source of funds of a business? If a business wants to grow if we as management want to grow our assets, we want to grow the amount of cash that we have, how do we do that? IPO could be, but I would say that's really just a change of equity, is really what that is. What is our third source of funds? An IPO would go in the equity section. Investors. Where does investors go, though? What source of funds is that? That's the owners, right? It's the owners. I know it's kind of hard to kind of think through. When we talk about investors, we mean owners. Yeah. What's that third source of funds? Close. Not really. I would say actually most of the time the government, we have to give money in taxes. We have to give money in... Absolutely. Specifically, profit. Right? The third source of funds that we have in accounting is profit. And it's the one source that we hope to grow the most as managers of the Color Supermarket. Right? Yeah, absolutely. But the question is, where does profit live? Where does it go on the balance sheet? Does it go on the balance sheet? We have a yes. You would say no. So this is great. This is great. Keep going. I think this is one of the things that trips up even most accountants as we think about this. Does the income statement connect with the balance sheet? It absolutely does. And specifically, it goes in the equity section. Remember that discussion that we were having, differentiating liabilities and equity? And specifically, the control mechanism? And what is the reward that an owner hopes to get from investing in a business? Dividends, right? Profit. Because they have control of the business and of the assets, they also have control of the profit. And they are also entitled to that profit. It's theirs. As long as the bank, as long as we as a business are paying the principal payments into the bank, they have no right to the profit. No right. It's the owners that have the right. To say it another way, the business is obligated to give its profits back to the owners when they see fit and when they see appropriate. Now the question is, it's hard to tell the story of profit using just a small box like that. We need a place to tell that story, right? And specifically, we want to be telling the margin story. And I'm going to go back to this. And someone hinted, you hinted at it. Profit is a calculation, right? And we get it by taking the income or revenue and subtracting the expenses. And the leftover is profit. However, we're only showing profit here on the equity section of the balance sheet. If I show that we have 400 in profit, a business has 400 in profit, is that good or bad? Absolutely. 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 To say it another way, to say what you're saying, I don't have enough information. I don't have enough information to say whether this is good. That's a great thing. Keep going. I would push back on that. It really depends. It really depends. Are we talking about profit over the course of 2 years, or are we talking about profit in the terms of in 2 seconds? It's a very different condition, right? And also, what type of business is this? The example I like to give is comparing a paperclip business and a submarine manufacturing business. Okay? So, say we have another business that we're interested in exploring, and it's the paperclip business. And you find out that you can buy a paperclip for 1 Saudi riyal. Okay? But you find out that you can sell that same paperclip for 401 Saudi riyals. Would you say that that would be an interesting business to pursue? Why? Yeah, it's a high profit. Specifically, the profit margin is really high, like over 99%. I mean, these are the types of businesses that investors like just run at, right? Yeah, I mean, the profit margin is so high. Let's look at the submarine manufacturing business, though. If, over the course of 2 years, you manufacture a submarine and you sell that submarine for $1,400,000 US. However, your cost or your expenses for that submarine, for making that submarine, are $1 million. Would you say that that would be a business worth pursuing? Why? The profit margin is so small on this. Absolutely. Specifically, the profit margin, the story of the performance of the business, specifically in terms of the profit margin. Yeah, these could not be more different companies, even though it's the same profit. Absolutely. Absolutely. It's not worth it. So we need a place to tell the story of profit. We need a more elaborate way to tell the story. It is. It is. I would say the funding story can be just as important, but profit arguably is the most important. Because why are you in business? Right? To make a profit. Yeah. So, we need a new place to tell that story. Now, I want you to imagine you're back at your desks or just in front of your computer. On the desktop, there is a file folder. What happens when you double-click on that file folder? Yeah, it opens. It opens specifically for you to see more file folders or more files. Right? So when we specifically double-click on that profit box in the basis framework on the worksheet that you have in front of you, when we double-click on that profit, it expands. And it expands to the bottom 2 boxes, which are income and expense. And it's the income statement that tells the story, what type of income is this? And what type of expenses? And what is my profit margin? And not only profit margin, but over the hundreds of years that accounting has been in existence, we've actually gotten even more technical. We talk about operating profit. We talk about operating profit excluding taxes, because we really want to get really specific on what type of profit is being generated. And we do that on the income statement. But the question is, which box is for expense and which box is for income? Do we put the income on the green side or on the yellow side? Now, most of us want to say, okay, I know assets are good, and income, I would say income is good. Mm-hmm. And we want to put it on the same side. That's how most people think of it. But if we go back to the question of the yellow side represents the source of funds, and Fuad Storm. Yeah, absolutely. We have this third source of funds, which is income. And specifically, funds used, and actually we really like to call expenses. They're the funds being used up that you don't get back. They're the funds being used in the business, the activity of the business. But it goes on the green side. Now, I will say for those, I will interject at this point, Badr's question of debit and credit. If you have taken accounting classes, we at Color Accounting believe debit and credit are some of the most confusing things about accounting. And if we can eliminate them and replace them with something that our minds actually process a lot better, which is colors, you will remember it better. And so, credit is yellow, debit is green. Is debit bad? Is debit good? Is credit bad? Is credit good? It's just, it is what it is. Green is green, yellow is yellow. Debit is debit, credit is credit. So from here on out, I'm not going to use the term debit and credit, but know that we think very strongly about debits and credits in using color accounting and in using it in universities as well. And we do not ignore the accounting principles. Rather, we replace them with more helpful mnemonic things that actually help our brain process what in the world is the accounting system doing and how does it help me in decision making. Yeah, Fuad. That's a great question. And one of these questions that we have more time in the broader and the bigger and longer training that I do, we actually work through this. And most of the time, what is most confusing to people is actually the idea of perspective and who's telling me it's a debit or credit. So actually the bank statement is a very confusing piece of information for most of us. And we actually have to remember, most of the time a bank statement is not our, as a business, statement. It's the bank's. It's from their perspective. So it's not the same thing because they're not us and we're not them. So that becomes really confusing. Even in the term debit card and credit card causes a lot of confusion, right? And that's why we say, let's just remove that vocabulary. So debitum and creditum were the Latin terms that were used when the first accounting textbook was written 500 years ago, and they've largely still been in place. We at Color Accounting say, why confuse people with those words? Let's put colors. So we'll actually see that when we look at the activity as well. Great question. Yeah, yeah. Uh-huh. Yep. So remember how I said the double click? Yes. Mm-hmm. That's a great question. We're actually going to see that in some of the examples. Yeah. You're ahead of the game. No, don't apologize. You're obviously thinking 2 steps ahead. Okay, you got the experience. Yeah, absolutely. Okay, now let's flesh out an example. So say, for example, we have 700, and actually, although we're a supermarket, we decided to do a little bit of consulting work, of consulting training, even before we start the business. And we ended up being able to go to a client's office, do some consulting in how to start up a supermarket, maybe in how to get funding, maybe, because we were so obviously so successful at it, getting funding from both a bank and investors. So we decided to give them some consulting on how to get funded. And they're so happy with us. We consult with them for a couple hours, and they pay us in cash the same day. And they pay us $700. We're thinking, yes! Now, how do we record that event in accounting? We've got 700 more cash, right? Okay, so we know we need to show there's an increase in cash, but then we also know we have more of something else, right? Specifically, what do we have more of? We don't have expenses yet. Yeah, profit. Specifically, though, income. Specifically, we have income. Specifically, we have consulting income. So, again, every event has two effects. So we put one effect, a green, we call it a green ticket. We put a green ticket on the side of the asset showing an increase in cash. We also have a yellow ticket that we show in income. We now have more income. Are we in balance? Yeah, increase in cash and an increase in the source of funds. Absolutely. Okay, the next event. We're all so excited that we got the $700 in consulting. We're so excited, but we know we need to go across town and drive back to the office. We didn't take our car. But instead of doing Uber, we decide, hey, this is our first consulting contract. Let's go big. Let's rent a limo and take a ride back to the office in a limo. And we decide we're going to get charged $300. Now, we have the cash in our pocket, and so when the limo says, hey, it's $300, we say, man, that's really expensive, but I got the $700 from the consulting. I'll pay you $300, limo driver. But I know I at least now have $400 in profit, right? So we've at least netted out. We at least have some profit. That said, how do I need to record this expense? Do I have more cash, less cash, or the same amount of cash after this event? I paid the limo driver. Yeah, of course we have less cash. So we need to show that. How we show that is actually a yellow ticket showing a decrease in cash. But now we also have more of something else. And Fawad, you hinted at it. What do we have more of after this event? We have more expenses. Specifically, we have more travel expenses to get back to the office. However, do we still have profit? Yes. And we now see that this profit amount actually changed. It was 700 because there was only income. But now we see it's 400. 700 minus 300. And that flows up into the profit box, which is in the equity. And we now know that the owners ultimately have the right to that $400 in profit. Yeah, timing can vary. Timing can vary. Absolutely. Timing can vary. But for this illustration, we just decided to do it that way. Yeah. But timing can absolutely vary. But notice, each event having two effects. Each event. Okay? Now, we're going to do a little bit of a review. And in color accounting, we like to condense each box, each one of the major 5 categories, all 5 categories. We like to simplify them and simplify their definitions as best we can. We've gone over the balance sheet. Let's review that. What is our one-word definition for asset? Valuable. It's the only thing in accounting that's valuable. Absolutely. What was our 3-word definitions for liability and equity? Can anyone remember? Close. One of them was ownership. Measurable is an asset's measurable, although a liability and an equity has to be measurable. Specifically, they're obligations. Liabilities are obligations. specifically to lenders. Equity, on the other hand, is an obligation to our owners, sometimes called investors, sometimes called shareholders, sometimes called stakeholders. But owner, they're the one who ultimately control the business and who get the reward of the profits, right? But what is the definition for income and expense? And just a test, for those of you who have accountants that you work with, I'm just curious if you would ask them, hey, do you think you could define income for me? It's actually kind of hard to do. And even as an accountant, if one of my clients asked me to do that, I think it'd be a little hard. Interesting, we were talking about the U.S. Department of Taxation, which is called the IRS, the Internal Revenue System. We were talking about that at the break. And interestingly enough, the IRS uses the term income in their definition of income. It's kind of like a circular thing. It's like, okay, what does it really mean? Well, it's cash in and cash out. Well, not really, because sometimes you can have income but not have cash. Well, it's an economic benefit. Okay, but like, how helpful is that? And so it's actually kind of hard. But maybe a simpler question. What's the sound of income? What, say it again, Fawn? Cha-ching! I've done this training on three continents, and it's interesting. No matter where I am in the world, it's the same response. What's the sound of income? Cha-ching! Right? Yeah. Why is that not correct? Close, yeah, close. I would say that cha-ching is really the cash register, which is really an asset. If you're in the saloon business and you own hair salons, the sound of income for you is snip, snip. I'm in the training business, training and consulting business. You could argue that the sound of income for me is the sound of my voice. If I'm talking, and mostly if I have a contract and I'm talking, but if I'm talking, that means I'm getting paid. I'm doing an activity that's generating value. It could, but specifically we're defining income, not necessarily the entity as a whole. Yeah. But so what we like to say about income is any activity that generates value for the business. It's a value-generating activity. Another way to say it, we like to call income and expense more like verbs. It's the action being done, whereas the balance sheet boxes, assets, liabilities, and equity, are more like nouns. They're more stationary. To say it another way, a balance sheet is like a snapshot. It's a specific instance in time. If you actually look at Coca-Cola's balance sheet, you'll actually see it has a specific date. But actually, for those of us that have done consulting in those bigger companies and have closed the accounting records, Badr and I were talking about this earlier, it's actually not just a day, it's a specific second. It's actually a specific nanosecond, right? Just like a photo. So a balance sheet is like a snapshot. No. A balance sheet is always an instance in time. Always. But an income statement is more like a film. It's more like a movie. It's over the course of a period of time, and it's describing all the activities that went on over that period of time. Oftentimes a year, but if we're talking about quarters, it can also be quarters. And actually, so at the top of any income statement, you'll actually see this is for a period, 12-month period, 3-month period, ending at a certain day. It's more like a film. It's more like a movie. Now, if the definition of income is the activity that generates value, what could we say the definition of expense is? Yeah. Activity that decreases the value of a company, that goes away, that sacrifices is actually the term we like. It's the activity that's sacrificing something valuable, hopefully in order to get more income, which will drive profits, right? But it's the activity of the business that we have to pull in assets in order to sacrifice, in order to spend them. Yeah? Yeah. That's a good question. Let me frame it another way. Income represents and is a symbol or a summary of the activity of the business. So, and remind me your business. Your business is consulting, doing CVs, and but who's doing the work? There's someone sending the email. There's someone having the phone conversation. There's some value that your customer is paying you for, that you're doing for them. Right? Right? But in the business in the accounting world, specifically for our business, that activity is generating value. It generates the cash that we hope to be getting. Yeah, and it's a summary. It's not the activity of it's not the activity itself. It's the summary of it, and we call that summary income. Yeah, great question. So expense, we call expense the activity that's sacrificing value in the business. So anything that causes the value of the business to decrease, essentially. Any questions about that? And it's okay. There's not time-wise. How are we doing, brother?
I guess we passed 7.
Okay.
Yeah.
I got a couple more things, and we'll jump
7:20.
into the activity if there's still a lot of time. Okay. One other diagram that I like to kind of explain the accounting cycle that makes the basis framework, the module of accounting, the framework that we use to describe accounting, really helpful, is to describe the value. So typically, a business starts with its owners. They have an idea. They then typically get funding from loans or from a bank. They then invest that money into assets. They then have to sacrifice that activity in some form or fashion. They have to spend that cash. They have to use the inventory. But that's hopefully generating income that flows back to the owners of the business through profit. So it's just a simple diagram describing kind of the life cycle of accounting. It could. Theoretically, it could. But I think most of it typically has to start with the owners. And that's why we start with the equity. Even if you're an employee, you're getting funding from somewhere else. Yeah. That's true. It could be. There could be a slightly different shape, but this is the typical model. Yeah. Another way to describe it is assets are the protagonists or the main character of the financial statements. And how does that work? Well, we know that liabilities are the obligations on the assets to the lenders. Equity, they're the businesses obligated for those assets to the owners. Income, it's the way we generate assets. It's that activity that's generating value. Similarly, expenses, it's that activity that's sacrificing value. Now, I said it briefly before. Same 5 categories in accounting, no matter what industry or no matter what type of entity. Government, thanks for coming, guys. Governmental entities have 5 boxes, but they're called something different. Typically, we see them called net assets and equity, and sometimes we'll also see expenditures being used in the expenses box. And we typically, in government or in nonprofit, typically don't use the term profit. We usually just call it deficit and surplus, but it's the same profit box. It's the same thing. It's the excess. Similarly with your personal finances, assets, debts, but equity is often called net worth instead of equity. And oftentimes personal financial advisors, they're often asking a lot of questions to get at this one number. What is your net worth? What is the value that you have of your assets over your liabilities? And typically it's your earnings and your consumption. Plus overtime? plus maybe your ideas. Yeah. Okay. Let's jump into, how many people do we have? We've got about 12. So maybe 3 groups of 4. And I've got basis boards here. And if we wanted to kind of divide, Bethel, what do you think is the best?
3 groups.
3 groups?
Yeah. 3 small
and
groups.
Actually, in the interest of time, I might actually have, can I have 3 volunteers, actually? I'm just going to keep this to 3 volunteers. And maybe the rest of us could kind of stand up and watch them. Can I have 3 brave volunteers? You're going to be doing accounting using a basis board, a real-life basis board. Oh, come on. I know I've got some courageous people. All right.
Yeah.
All right. 1, 2 more.
Okay.
You won't get chided. Fawad, all right. You got voluntold. 2 more volunteers. Okay. Do we have any accountants in the room? All right. With them. Okay. Here's your basis board.
You.
Okay. And these are, and actually, could she have a partner to help her with this? She's going to need some help. Okay. So in this pouch are what we call tickets. And Wissam, this is can he have a partner? Ya Walid. And these are his tickets. And I need one more. I need one more volunteer. If no one, no problem. We can just do 2. Okay, no volunteers. Okay, now, if everyone can kind of gather around these 2 groups to kind of get an idea, so you can kind of see, and this is the full 1-day and 2-day trainings that we do. Every student gets one of these, and we actually practically think through the accounting system. And what is your accounting system doing? Your systematized, computerized accounting system, whether it's Xero, whether it's SAP, whether it's something customized, what is it doing in the background so that you understand the fundamentals of accounting? Okay? Now, in the plastic pouches, we have tickets. And there are green and yellow tickets for each event that we're going to go through. Okay? And the learning mechanism is you're going to use 1 green ticket and 1 yellow ticket for every event and decide which boxes to put your green ticket and yellow ticket in for each event. There are currently only 9 boxes. No, each ticket represents an event. So 1 business event, and we'll walk through these. We've actually already done 4 events, and we're going to go back through those. Okay, so let's use this. So the tickets, and it might actually be better to actually put the tickets down. I'm bumping my microphone. To actually put the tickets down and go ahead and number them off. So each event has 1 green and 1 yellow. So there should be just as many yellow tickets as green tickets. So if you can find the 1, 2, 3, 4, 5.
In? Bye.
We're going to take a little time. Yeah. So the one event has a green and a yellow. There should be
Yes,
30,000.
article.
Exactly right. Yes, exactly. They'll be aligned.
I'm still confused with the color. So green is debit,
Uh-huh.
yellow is credit.
Uh-huh.
Okay.
But see, yeah,
Okay.
it's the systemized way.
Okay.
Okay, we think we're ready? All right, our team's ready. You guys are fantastically brave. I am not going to give you a hard time at all because you are the brave ones. Okay, let's look at the first event. We have a loan from a bank, 30,000. We have a green ticket and a yellow ticket. Where do these
30.
go on the basis board? You're going to put the green ticket in one box and the yellow ticket in another box.
Mommy.
Yeah. There's a cash bucket. Okay, so how did you guys account for this event? What did you do? Okay? So you put the green cash ticket in the cash bucket. And that cash bucket is where again? What quadrant? Yeah, it's an asset. Okay? And then what did you do with the yellow ticket? A loan from the bank. Because we now have an obligation to the bank. Right? And where is that loan bucket? It's in the liability section. Absolutely. Fantastic. You did your first accounting transaction using the basis framework. Congratulations. 100%. Mille de mille. All right. Now let's do the next event. We get an investment from owners of 20,000. 20,000 cash that we receive from the owners. How do we account for this event? Every event has two effects. Has a green ticket and a yellow ticket. How do we account
Yes.
for this?
Right.
Why? It's cash. We now need to record that we have more cash, right? And those two tickets in the bucket represent two different transactions that, in summary, are a total of 50,000, right? Two different transactions, two different tickets. Yeah. Okay. Now, what did you do with the yellow ticket? You put it in the equity, specifically in the bucket called contributed equity. And why did we put it there and not in the liability section? Yeah, it's an obligation to the owner or to the investor. Fantastic. 2 for 2. You've done your second transaction. And just know, this is what your accounting systems are doing in the background. Always. Always. There are two things going on for every single event that happens. Every single event. Even though you just say, hey, I just received $200 in cash. What your bank is, or sorry, not what your bank, what your accounting system, your digital computerized accounting system, what it's doing in the background is trying to figure out what the source is in the background. And oftentimes you will do that by either doing a journal entry or sometimes saying, this is from an investor, not a customer. And it knows to funnel them into these different categories based on the event that you're describing. Right? But it's important that we actually learn what it's doing in the background, right, in order to read the reports that these computerized systems are generating. Okay, another one. We're actually going to run through 3 scenarios, all of them in terms of earnings, right? Specifically income and how they affect income. The first one should be more simple. So we received, in fact, in this, I'll just go ahead and read it. We actually have, if we had more time, we can actually read all of them, but I'm just going to read this event. So we performed training and we got paid cash the same day. Very similar to the initial trial session that we were doing earlier. And on February, this happened on February 1st, and it's 700. Now, how do we account for this event? We performed training and we got paid cash. How do we record that? Okay? In the cash box. Okay.
Yeah.
We received 700 in cash, and we have already done the training. We've already performed the activity. So how do we account for this event using the accounting system? Right now we have no cost. No cost. But that's a great question. So what did we do? Where did you do with the green ticket and the yellow ticket? Okay? So you put the green ticket of cash in the cash box, because what is that representing? It's representing that we have more cash, right? We now have more cash after this event. We've done $700 worth of training. Yeah, we need to record that. We need our cash balance to reflect that. Absolutely. Now, what did you do with the yellow ticket? Yeah, and where'd you put that? In the income box. Absolutely. Yeah. Are we in balance? Yeah. Why did we not put the yellow ticket in the liability or the equity section? Yeah. We don't. Specifically, we got funding from customers. And where do we show that? We show that in income. And ultimately, it flows up into equity because the owners have the control over that money, right? Ultimately. But we show it in income. Yeah. Okay.
It should be in a sub-account called other income.
Yeah, it
because
could be.
it's not the main activity of the
It
business.
could be. If we were a training business, it would, and we'd want to put different buckets. And so each bucket that is on your basis board actually reflects a different sub-account in your accounting system. And this is where the customization happens in accounting. There's a lot of customization. There's a lot of different things you can call these little mini buckets, aka the account names in your accounting system. And they really need to reflect the needs of the business, not what your accountant thinks. Just FYI. That's a tip, free tip. Okay. Next one. Let's okay, great. Next one, I'm going to skip to transaction number 5. This one might be a little bit more complicated. Now, or transaction number 6. I might have already given it away. We receive payment from a customer, but it was in advance of training. Okay, so we have received cash, but we haven't yet done the training. How do we account for this event? We received 600. We received 600. So this is actually a transaction number 6. Could be. Possibly. Could be. But it's from our customer, though. It's true. We haven't yet done the training, correct? Correct. But we've received we have received the money. We have received the money.
The key word here is recognition. Do we recognize it or no?
Okay. Do we want to do this one together? Do we have, I always like to start with cash. Do we have more cash, less cash, or the same amount of cash after this event? Okay, so we know we're going to do something with cash, right? And do we have more or less cash? We've got more. How do we show that we have more cash? Yeah, how do we do that? We put a green ticket in the green bucket, right, in the cash. So that's what we've done on the green. So we put the green ticket, which represents the receiving of the cash, into the green bucket. What did we do with the yellow ticket, though? Why do you say it's not income? We have not performed the training. Okay? Could be. At least it is on this board. But we received the money. So many entrepreneurs, so many startups and say, hey, I've received the cash. This is income. But you're actually right on. Why is this considered a liability? We're obligated to perform training or to give the money back. And where do we show that we are obligated, specifically to lenders or creditors? Where do we show that? In the liabilities. In the liabilities. Not in the income. It is not income yet. Because the activity, just like we said, is not complete. It's not finished. You have the money. We're really obligated to do something with it. Yeah, so it's not profit. Yeah, it could be canceled. We might need to return it. We might do it, but we might not. And we need to distinguish it. We really need to distinguish it. Just interesting. Who here has bought any gift cards from Starbucks or from, prepaid cards? Does anyone like Starbucks? Here, I love Starbucks. Has anyone bought a gift card from Starbucks, maybe as to give as a gift from someone? Yeah. What is a gift card? Yeah, it's like a prepaid card. But from the business's perspective, what is a gift card? It's a liability. Yeah, absolutely. There is something that they need to perform. They are obligated to their customer to either give them services, to give them products, or to return that money. It's not income yet. Does anyone want to guess? So Starbucks is very famous for giving gift cards. Does anyone want to guess what the amount of deferred revenue on Starbucks' balance sheet is at any given point in time? Probably not, but it might be. Does anyone want to guess? Starbucks, multinational company. 10 million? More? Okay. How much more?
100 million?
100 million maybe? If I told you it was over $1 billion at any point in time, and what really is that from a financial perspective? What is that money? Bingo. It's a cash-free loan from your customers. Interest-free loan. Sorry, interest-free loan. Interest-free loan from your customers. You're still obligated. And this is where the legal world and the accounting world kind of converge, because actually each country is different in the legal obligations to this. So in the States, companies are prohibited from canceling gift cards before 3 years. So they have 3 years. But after that, it's theirs. Free profit. Maybe the cost of the cards only. And maybe some lawyer fees. Right? Yeah. Would this be an interesting tool to have as a startup? Funding from your customers. That sounds very interesting. There's a lot of crowdfunding going on, and that kind of fits in this paradigm, doesn't it? Yeah, but it's an obligation. And there's different ways. And the legal world needs to kind of discuss with accounting, how do we account for that? In the interest of time, I think we're past quite a bit.
Beyond.
This is, I want to fast forward just kind of through a lot of these expenses. First, just want to say congratulations. Everyone can sit down. We can pass these. And my courageous people, my courageous volunteers, congratulations.
Thank you.
You are doing the accounting system, and you guys really picked up on it fast. And that's really exciting. It's really exciting for me. Really exciting. So
So,
I just want to say
okay.
first, thank you to everyone for coming. And
Mm.
first, you've learned the accounting system. And in the longer day training that I do, we actually all have these, and we go through 15 basic transactions in accounting to help solidify these concepts for us. And we do them together. But then we also, one of the other things we do at the very end, you know how we started with the balance sheet and income statement? It's often very confusing. I don't know if we remember the image on the board. So we actually look at the balance sheet and income statement, and I get you to highlight with these fancy highlighters that we have the main categories, the main boxes of accounting on the balance sheet and income statement, and define them. And we also go through the income statement and we highlight the main aspects and
Okay.
specifically how these are matching to the basis framework.
So this is credit, debit, right?
Yeah, absolutely.
Okay.
And then what we do is we actually condense this into a paragraph and we tell the story of this business. And you actually get to see, okay, how can you interpret this financial data, understand the story, and maybe even make some decisions from it. And even in the more, sorry? We do have a little bit of financial analysis, including even a budgeting tool at the end. And that's more for a 2 or 3 day training just because it takes time to kind of build up the framework to do that. But yeah, we do that. One last thing that I'll say, this is a personal interest of mine, is the personal finance aspect as well. And I suggested earlier that this basis framework, the 5 boxes, they're just as applicable to nonprofits and governments as they are to your personal finances. And I think this is a really helpful tool that I'd love to see in schools and universities, even across the broader public, to help people better understand their own personal finance situation. And how do we do that? Well, typically, we start talking about personal finance in terms of savings. How much are your savings? What's your net worth? And how to grow that. Oftentimes, we describe needs versus wants, and that's in consumption. How do you distinguish between a need and a want in order to decrease your expenses so that you can increase your savings, right? Another thing we talk about is debt management. How can you restructure your debt, whether it's credit card or a loan from a bank for a car or various things? How can you structure things to decrease the amount of interest that possibly you're paying, right? Because that's an expense. Another thing we do in personal finance is we can talk about active income versus passive income. Active income is your salary. You have to show up, you clock in and you clock out, and you get paid. But passive income is kind of income as you sleep. That's your rental property that you're renting out. That, yes, there's kind of some minimal work that you need to do, but you're really getting paid for really not much activity, for really owning it. It's really a passive stream of income. We then can use this framework to even describe 3 different types of assets. Is most of the assets that you own, are they depreciating in value? Do you have a lot of cars? Do you have a lot of electronics? Do you have a lot of furniture? Which over time decreases in value, which over time is going to decrease your net worth. Or do you have assets that are appreciating in value? Do you have land, houses, stocks that over time are increasing? And how can you change the type of assets from depreciating to appreciating? And then one of the other things, I think many of us are people of faith, and I like to kind of say that not only are we interested necessarily in growing our own net worth, but especially once we get to a place where we have a high comfort level with where our own personal net worth is, how can we contribute to things that invest not necessarily in our own lives, but in the future generations? And I like to say investing even into eternity. Not thinking just in terms of your own kind of cash net worth, but even thinking, how can I give? And changing even the dynamics. So again, it's just a helpful framework to think about even personal finances. I don't know if we have any time for questions. I have already taken too much of your time. I'd love to get your feedback, but I also don't want to keep you. I think one of the things that's going around is a sign-up sheet. So what you've tasted today is a small demonstration of the broader training that I do, and I often customize training to meet certain needs. So whether it's startups, whether it's mid-level managers, whether it's investment funds, and kind of tailor a training. But I would love to come back and do a more full 1 day or 2 day workshop. And so if you're interested in that, please sign up. And I'd love to talk with the great folks at Startup House about maybe facilitating something like that in person. Or we can have more dialogue. We can dive a little bit deeper and talk about even your specific circumstances and situations. So, yeah, please feel free to connect with me on LinkedIn. And I'd love to give you my business cards for those that, those that are interested. And thank you so much.
تمام.
First,
Thank
thank you.
you. يعطيكم العافية. شكرا جزيلا. Thank you, Mr. Clark. And actually, this is from.
Oh, wow.
Yep. Please.
Thank you.
Yeah. We're gonna take
Oh,
a
of course.
photo of it. Yep. All right, man.
Thank you, brother.
Thank you so much.
Thank you. It was a pleasure to be
very,
here.
very important. It was a very informative session.
Joey.
Yep. Again.
Thank you, thank you. I'll be turning the mic off, but I'd love to have questions if for those that want to stay around. So thank you so much, all of you, for being here. I loved having you. I loved all the excitement and the fun that we had, and hopefully we can do this again, inshallah. Inshallah. Yes.
Yeah.
Yes. Yes. Thanks so much. Pleasure meeting you.
Thank you. Take care of you. حبيبي. حبيبي. تشرفنا بيك.